Growth stocks are an important part of every portfolio. Specifically, medium cap companies that are worth between $2 and $10 billion can provide a lot of growth for your portfolio. Recently, I've come across these 5 amazing growth stocks, all of which have a lot of potential. In this video, I will give you a brief summary of every one of them. If you want to find out more, press that like button to support the channel and stick around. The first one of the 5 growth stocks is ACM Research, or ACMR. Founded in 1998, ACM Research develops, manufactures and sells single-wafer wet cleaning equipment for enhancing the manufacturing process and yield for integrated chips worldwide. They have had a phenomenal run since the start of 2020, going from $18.93 at the start of January to a high of $140 in February 2021. Right now, they trade at about $83.4. The best thing about ACM Research is their expected revenue growth. The company is expected to see an increase in sales of 49% in 2021 and 35.4% in 2022. Their earnings are also meant to increase by 16.4% in 2021 and a massive 44% in 2022. Their price is a bit steep right now, with a price to earnings ratio of 61, price to book ratio of 10.1 and price to sales ratio of 8, but I think that their growth justifies the valuation. ACM Research have low debt, plenty of cash and are expanding actively, so it is definitely one to check out in my opinion. Looking at the chart, the current price does not seem too bad, but it looks like there are a couple of support levels at $77 and $60 to $65. The next resistance level is at $106, so the risk to reward ratio is not ideal, but it's okay. I'm personally thinking of starting a small position now and adding to it if it drops to one of these support levels. The second growth stock that I want to talk about today is Digital Turbine, or APS. Digital Turbine is the leading independent growth and monetization platform which is powered by code installed on devices by global carriers and original equipment manufacturers. Essentially, it is an advertising tech company. Digital Turbine is expected to explode over the next 12 months with an expected revenue growth of 280% and earnings growth of 117%. In the 12 months following that, they're expected to see another 32% jump in revenue and 45% jump in earnings. As you can see, Digital Turbine is entering a very exciting stage in its life. Last quarter, the company beat analyst expectations on both revenue and earnings and also improved guidance, but it still fell by 3%. It is expecting between 300 and 360 million in revenue next quarter, which is over 50% higher than its revenue of 212 million last quarter. So you can see that Digital Turbine is not messing around. Currently, Digital Turbine is trading at a PE ratio of 92, PB ratio of 10.4 and a PS ratio of 11.3, which seems to be a good price for its current potential. Its forward PE is actually 24.9, which is really cheap for a growth stock. It currently trades around a strong support level, so to me personally it looks like a good opportunity to enter. Make sure you do some additional research before buying in though. The third growth stock is Onto Innovation, or just Onto. Onto designs, develops, manufactures and supports control tools that perform macro defect inspection and metrology. They also offer lithography systems and process control analytical software worldwide. Essentially, Onto helps semiconductor companies solve their yield, reliability and quality issues. Analysts are expecting to see a 37% jump in sales with Onto and an 85% increase in earnings in 2021. The year after, they only expect a 10% revenue growth and 13.4% earnings growth, but that is still decent. At the start of August, Onto beat analyst expectations on both earnings and revenue with a revenue of 193 million and a non-GAAP EPS of $0.92. The company is expecting similar results next quarter as well, which would result in a roughly 130% increase in earnings as compared to the same period last year. Overall, Onto is growing at a good pace. Unlike the previous 2 growth stocks, Onto is currently trading at its all-time high, so maybe it's not the best time to buy it. Even so, its valuation measures are relatively cheap, with a PE of 40.9, forward PE of 20.5, PB ratio of 2.7 and a PS ratio of 5.5. Onto has no long-term debt and cash and cash equivalents of 410 million, so the company is at a good position in my opinion. The fourth growth stock is Shift4 Payments, or FOR. Shift4 Payments provide integrated payment processing and technology solutions in the United States. They also offer a suite of technology solutions such as Lighthouse, which is a cloud-based intelligence and customer relationship management tool, and Skylab, which is a mobile payment solution. At the start of August, Shift4 Payments released their earnings for the second quarter of 2021. We saw a revenue beat with a 147.5% revenue growth as compared to last year. Shift4 Payments also beat earnings estimates with a 30% earnings surprise. For 2021, the sales of Shift4 Payments are expected to grow by 80%, followed by 34% growth in 2022. They were unprofitable in 2020, but in 2021, they expect to see an EPS of $0.58, followed by a 106% increase in 2022 to $1.2. As you can see, this is massive growth. That's why their valuation right now is steep. Their PE ratio is 365, but their PS ratio is 6.9, their PB ratio is 15.6, and their forward PE is 71.9. Despite that, their valuation is much cheaper as compared to some of the other players in the fintech space. Given Shift4 Payments' recent price movements, I think that this could be a good entry point. However, if you buy into the stock, you should know that a lot of its price is based on its expected performance. If Shift4 Payments misses earnings or revenue or lowers guidance, we will most likely see a big drop in price. To be honest, that applies to most growth stocks, so it is something to bear in mind. The final growth stock is Shoals Technologies Group, or SHLS. Shoals Technologies Group provides electrical balance of system solutions for solar energy projects in the United States and offers eBOS components. Its main customers are engineering, procurement, and construction firms that build solar energy projects, so it's essentially a B2B company. Obviously, solar energy is growing fast in the US, so we have a good bullish case for Shoals. They recently released results for the second quarter of 2021, and they were pretty much in line with an EPS of $0.09 and a revenue of $59.8 million. The sales of Shoals Technologies Group are expected to grow by 35% in 2021 and 51% in 2022. In terms of earnings, they are expected to see a decline of 15% in 2021, but that will be followed by a jump of 75% in 2022, which evens it out. The solar industry has taken some hits in 2021 due to rising commodity and shipping prices, so the drop in earnings is not a surprise. Currently, Shoals Technologies is valued at a PE of 169 with a forward PE of 62.3 and a PS ratio of 28. They do not have a PB ratio because they currently have a negative equity, which is not a great sign. They also have tiny cash reserves compared to their debt, which personally makes me feel a bit uneasy. They currently trade at a price of $33, close to a resistance level of $37.5, with their most recent support standing at $25.7. Personally, I think that the company has a lot of potential, but I will not buy it right now. However, I will definitely keep an eye on it. If their financials improve, I will certainly buy it. So, these are 5 growth stocks that have a lot of potential right now in my opinion. What do you think? Which one is your favorite? Let me know in the comments below. If you enjoyed the video, please leave a like, comment and share it to spread the word. Thanks for watching and I'll talk to you again soon.